Stock market volatility and the tumble in equity benchmarks earlier this year has led to downbeat talk on Wall Street lately.
The crash is coming.
It's going to crash.
When the crash comes,
the correction is going to be huge.
What led to this market meltdown?
The terms market crash, correction, and meltdown are being bandied about by traders and analysts in ways that can make investors nervous. The Dow Jones Industrial Average dropped a record 1,175 points on a single day in February and fell another 1,000 points a few days later. So, did the market crash earlier this year? Here's how to better understand some of the lingo associated with significant market downturns. Words like market sell-off, meltdown, or crash can be emotionally charged, but rather vague. There are, however, a couple of terms whose definition is actually tied to math. Market participants usually define a correction as a decline of at least 10% from a recent peak. A bear market, however, is characterized as a decline of 20% or more. Corrections, as their name implies, suggest a more natural and potentially less disruptive cycle in stocks. But a bear market can put a damper on investor sentiment, with participants uncertain about when stock losses will cease and a new uptrend will emerge. For example, in February, the Dow Jones Industrial Average dropped by at least 10%, which means it fell into correction territory. That was the first time we dipped into a correction in 2 years. Another way to know whether a sell-off is a crash is to look at treasury bonds. The treasury yield curve, a chart showing the yield on treasuries from shorter to longer maturities, has been a good indication of how investors feel about the economy. In a normal environment, long-term yields will be higher than short-term yields because investors demand greater return for lending money over a longer period. But if the curve inverts, meaning long-term yields are lower than short-term yields, that suggests that investors harbor doubts about long-term economic expansion. An inversion of the yield curve has preceded every recession since World War II, making that market phenomenon a closely watched one. At this point, the yield curve is not inverted, but it has been becoming flatter, which makes investors worry that it is dangerously close to inverting. Finally, taking a look at economic data is another way to determine whether a sell-off is a crash or just a correction. Currently, all signs are pointing to a healthy economy, most notably low unemployment and stronger GDP growth. And keep in mind that stocks have actually dropped 10% from their peak 2 out of every 3 years since 1979. Even so, the market has still posted a gain most of those years.